Welcome to Wealthion. I'm Wealthion founder Adam Taggart. The housing bubble has popped and the Fed can let it rip. Just how bad may things get from here? Well, we sit down with Wolf to find out. Wolf, thanks so much for joining us today.
Thanks for having me, Adam.
All right, Wolf, what is your current assessment of the U.S. housing market?
It is pretty tough out there. We've had home prices spike by huge amounts in the last 2 years, and in some cities by 50 and 60% in a 2-year time span. And when mortgage rates were 3%, now mortgage rates are at over 7%. So the equation doesn't work out anymore. And the housing market is sort of reacting very rapidly to these much higher interest rates. It just does not work to have these kinds of home prices with 7% mortgage rates. And they have to adjust, and the interest rates are not coming down. So it's going to be the house prices that have to come down to make this market work again.
Let's talk about the recent piece that you mentioned that I cited in the introduction. You say in that piece that, quote, raging inflation knocked out the Fed put, and banks are no longer on the hook for mortgages. Taxpayers and investors are. So can you expound on that a little bit and explain how that adds to the risk of a housing market price correction from here?
The Fed is no longer required to bail out the housing market because the banks are no longer on the hook. As you said, the banks have, since the financial crisis, sold most of their mortgages to entities that convert them into mortgage-backed securities. And the qualifying loans, they have been sold to Fannie Mae and Freddie Mac and all the other government-sponsored enterprises and government agencies. So they're taxpayer guaranteed. And the loans that didn't qualify for being bought by Fannie Mae and Freddie Mac, they were sold to private entities and converted to mortgage-backed securities. So we have these private label mortgage-backed securities, and we have the government-backed mortgage-backed securities. And all of them are owned by investors. So they're owned by pension funds, they're owned by insurance companies, they're owned by bond funds, they're owned by global institutions. A bunch of them are owned by the Fed and maybe other central banks.
Let's say the banks were as exposed as they were before. Would there be more backstopping of the system because they're trying to protect the banking system? Like, in other words, can they just let the fire run more wild this time around because they don't have to worry about the banking system being taken down? Is it material in any way that banks aren't holding much mortgage debt this time?
So the problem with the banking system is that they take deposits. There's $17 trillion in the deposits in the banking system. So when the banking system gets in trouble, you're thinking about the deposits. But the shadow banks, they don't take deposits. They fund their mortgages in other ways. And so that's not really an issue for the Fed. The Fed doesn't regulate them anyway. So, I don't see any reason for the Fed to step in here. I mean, the Fed can let this correct and find the natural level where home prices should be, and the market will be fine. We've got lots of inflation and wages are going up. And so, I mean, there'll be a natural bottom somewhere in this house price decline.
What are the key contributors to this? And I'll start us off and you can build from there. One obviously is the Fed, right? It brought interest rates down to historic lows, right? And it also just provided lots of liquidity into the system. So it was easy to borrow, and it was easy to borrow at historically low rates. And when that happens, we talked about the seesaw relationship between cost of debt and home prices. Cost of debt goes down to historic levels. Well, no surprise that home prices went up to historic levels. Okay, so that's one. Anything to say else about that? And then what other contributing factors would you include?
You nailed that. Interest rates, mortgage rates are directly related to home prices. That has been well established over time. In the normal range, it's not such a huge difference. When mortgage rates fluctuate with the rate of inflation, you have that. So you have high periods of high inflation, you're going to have high mortgage rates, and you have periods of low inflation, you're going to have lower mortgage rates. And that used to be the case before the Fed started really getting into interest rate repression. So now we've had, 3% mortgage rates, below 3% mortgage rates, and for the last 2 years. And so that added another 50, 60% price increase on top of the already big price increases before. Coming out of the dot-com bust in 2000, 2001, 2002, the Greenspan Fed, so the Fed led by Alan Greenspan back then lowered interest rates because the stock market implosion was causing a downturn in consumption. And the tech bust especially, and a lot of jobs got decimated, high-paying jobs got decimated in that. And so to get out of that, the Fed back then decided to create a housing bubble to get over the dot-com bubble bust. And so we got the first surge in home price, unnatural surge in home price. Within a couple of years, home prices just shot up. And that imploded when the Fed saw that and started raising interest rates. So then we got the housing bust out of that. So then we went through it all over again in 2008, 2009. It takes housing. It took housing 4 years after the Fed stepped in before it actually started going back up. I mean, it kept crashing despite QE and despite record low mortgage rates at that time. So now we've got another and the most ridiculous spike ever. And mortgage rates are higher than they were 20 years ago. It doesn't take a genius to figure out where this is going. And yeah, that's just how it is.
So we had the low interest rates, as we talked about. We had the fact that because of that, there was really no way to get a safe yield.
The current investor portion of buying single-family houses, it's way down. So we were down to about 15% according to National Association of Realtors, and for the nation overall, that's down from the 20% range earlier this year. I sure that in Atlanta, there may be some neighborhoods or some more in some places where you have a concentrated buying by an investor, but on a nationwide basis, that's really not the case. Investors do not like to buy at sky-high prices. It doesn't make sense for them. They're professionals. They know they have to make money renting them out, and you can't make money if you pay too much. And so they have pulled back now too. I mean, they're not interested in this market anymore either. So I just want to add that to the investor scenario, which is a lot more complex than I think a lot of people believe.
All right, thanks for adding that nuance. I do want to earmark the last point you made there about them not buying as aggressively now because they don't want to buy into an overheated market, and a market that may actually now be correcting, because that's just one less marginal buyer at the table.